Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale. Welcome to this month's edition of Fixed Income Perspectives. Today we'll review key developments in the economy and what they mean for fixed income investors. In September, the Federal Reserve surprised the market by cutting interest rates by 50 basis points, or 0.5%. This was more aggressive than expected, which raised concerns that the Fed might see trouble ahead, particularly in the job market or economic growth. However, since then, the data has been mostly positive. For example, September's jobs report exceeded expectations and the unemployment rate fell to 4.1%. Consumers are also spending steadily, supported by rising incomes and strong household balance sheets. While inflation came in a bit higher than forecast, we believe it will continue to moderate over time. Overall, the economy remains resilient, with the Atlanta Fed now predicting third-quarter GDP growth above 3%. Now let's discuss the two key shifts in market sentiment. First, the Fed's outlook on interest rates has changed. They are now predicting another 50 basis points of rate cuts by the end of this year and 100 basis points more in 2025. In total, they expect to reduce rates by 2% over the next 2 years before reaching the neutral rate by 2026. This means the Fed is now more aligned with the market's expectations, whereas earlier this year, the market was more pessimistic and thought the Fed would act more aggressively. Second, Treasury yields have risen. The 2-year yield, which reacts quickly to Fed policy, is now 25 basis points higher than it was after the September meeting. Yields on longer-term bonds have also increased by 40 to 50 basis points, reaching their highest level since July. This shift is driven by strong economic data and concerns that inflation may take longer to fully resolve. We're also seeing more volatility in the market as we approach the election. Uncertainty over policies is a factor, especially since some proposed policies could increase government deficits and lead to more Treasury issuance. This would put upward pressure on yields. Despite recent market swings, total returns for fixed income investors remain positive across nearly all sectors this year. One reason is the higher yields available today. Higher yields can help cushion price fluctuations as the increased income offsets changes in bond prices. Looking ahead, this rise in yields presents a good opportunity for investors. With the Fed now starting a rate-cutting cycle, extending the average maturity or duration of your bond portfolio could be a smart strategy. Doing so allows you to lock in attractive cash flows and enhance potential future returns as rates continue to come down. In summary, we've seen strong economic data, a more balanced outlook from the Fed, and higher yields across the curve. For fixed income investors, this environment creates opportunities, especially with careful portfolio adjustments. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.